Hey guys, how's it going? It's Andy from Magoo Investing. Happy Wednesday. In today's video, I'm going to be talking about one of the only things that I've really been looking forward to so far this year. I think we can all agree that 2020 has sucked in a lot of ways, but one of the things I've really been looking forward to has been Spotify Wrapped, which is kind of the end of the year summary for all of the things and songs that you listen to on Spotify during the year. And so I'll throw my summary up right now on the screen, and I'd love to hear what you guys had as your top 3 artists from this year. But Spotify is one of these products that I've loved for so many years. And when I first started on this channel, one of the things that I always talked about is the way that I picked stocks when I first started investing in the stock market is I would find 5 companies that I used their product and absolutely love what they do. And then I would go from there to decide if I actually wanted to buy into that stock. So today I'm going to be making a list of the 5 stocks that I absolutely love based off of their products. And I'm going to go through kind of my analysis on how I would decide if I wanted to buy into these stocks. And I'll throw up my portfolio video from a couple days ago up above right now, but basically all the stocks that I've invested in are companies that I absolutely love, because the whole kind of idea of my investing strategy is that I want to buy stocks at a discount. And if I buy stocks that I absolutely love, I'm going to be less likely to sell them at a loss. So in today's video, I've picked 5 of my favorite companies. I'm going to give my analysis on the recent news and earnings reports, and then I'm going to hop onto the charts and talk about what I see for these companies as a potential value play based off of the technical analysis. So before we get started, I do have to say that I'm not a licensed financial advisor, and this is not financial advice. Anything you hear in this video is just me giving my own opinions on the stock market, and you need to do your own research before making any investment decisions. Also, if you've been enjoying these videos, I'd really appreciate it if you hit that like and subscribe button, as would help my channel out a lot. With that out of the way, let's hop into the first stock in today's video, which is going to be the inspiration for the video, which is going to be Spotify, ticker symbol SPOT. Currently, Spotify is trading for $303, and it's up 103% on the year. And today, when I was starting to make this video, I went and looked at the charts because I like to do the technical analysis first, and the stock was up like 10% randomly. Usually when you see a stock that's up double-digit percentage-wise, there has to be some sort of catalyst, because for a company like Spotify, that's a pretty unusual move. But when I looked at it, there wasn't any actual news, and the only news thing that popped up on TD Ameritrade was saying, yeah, there's no news for Spotify. There's nothing that really justifies this price action. Maybe it's because other people were thinking the same way that I was with the Spotify Wrapped, and were like, oh, I absolutely love Spotify, let me buy in. So kind of some of the price movement today is a little curious. When you look at Spotify, Wall Street has always kind of disliked how much money Spotify pays out in royalties to the record labels and the individual artists. One of the things that they've always looked at has been gross revenue, which is how effective a company is at turning revenue into actual profit. And so their gross margin of 25%, Wall Street wants them to do better. When you see some of these tech companies, usually you see higher price margins. And then we're going to be talking about one of my favorite companies in a couple stocks from now that has a gross margin of 97%, which is crazy. So 25% is great for some companies and it's bad for others. And Wall Street wants them to do better. But we've been starting to see kind of a switch in the business, which makes me feel optimistic that this gross margin is going to increase in the upcoming years. When Spotify first started, they really needed to get the record labels on their side, because there's no way that Spotify does well without the actual artist being on board. And so they had to spend a lot of money in royalties to get them on board. But now at this point, the way that people listen to music has changed significantly. The CD sales are pretty much non-existent. Radio is not as popular as it was. So now we're starting to see a switch where the record companies really need places like Spotify to get the online distribution. So some of the analysts are hoping that in the next couple years, when they renegotiate their deals, Spotify is going to be able to have higher profit margins going forward. But Spotify has been increasing their business in different ways by creating different revenue sources. They've invested in themselves heavily with places like podcasts. Just in the past year, they've seen major boosts to podcasts, which saw in the last quarter 70 million users, which was doubled from a year earlier. Some of the ways they've done that is that they've been producing their own content, similar to what we've seen with Netflix, where they've come out with the Michelle Obama podcast that was released this summer, and they bought the exclusive rights to the Joe Rogan Experience, which was not cheap at all. That deal was rumored to be around $100 million for their entire library. But it seems to be worth it because the Joe Rogan Experience brings in 190 million monthly downloads in 2019. So this has been a way to really boost the podcasting area of the business. This user growth has continued to increase for Spotify, and they're currently up to 320 monthly active users, which is very high. However, of those 320 million, less than half of them are premium subscribers, but they do have their freemium model, which plays ads every couple songs, and it does not allow people to download it and listen to it offline. So they still are bringing in money from that, but it's not as profitable as the subscriber model that they have. But the reason that I really love Spotify has been the growth and the overall market that they own. As of right now, Spotify is a leader in the global streaming market, accounting for 36%, which is relatively high. And you're starting to see places like Apple Music that has been trying really hard to take some of that market away from Spotify, but Spotify has been very resilient. For the past 11 quarters, Spotify has seen user growth increase by 26 to 30% each quarter year over year. So you've seen some incredible growth from Spotify, and they've been able to resist some of these major companies like Apple and Amazon trying to take some of this market share. From their last earnings report, they saw a beat for new subscribers, but their sales and earnings missed. And so that pushed the stock down a little bit. But similar to what I talk about with social media stocks, I think the user growth is the most attractive thing. So overall, I really love Spotify for the long term. I think the way that they've been investing in themselves has been really smart, and I think the long-term potential of the company is fantastic. They keep increasing their monthly users by 25 to 30% every quarter for the last 11 quarters, and they're expected to increase their margins in the future when they renegotiate with the 4 major record labels. So they finally increased their guidance, which shows confidence in their business, and I feel very good about Spotify for their long-term position. So with that out of the way, let's hop on the charts and I'll talk about what I see with Spotify, ticker symbol SPOT. Okay, so here we are looking at Spotify, ticker symbol SPOT. For the longest time, this stock had been pretty horizontal or was declining for a long time. We had this $200 mark back in July of 2018. It fell, and then it went pretty horizontal for a long time. And then you get the start of 2020, and it has been taking off ever since. But I have been watching Spotify recently because I want to kind of zoom in on this area right here. I would have called this a bearish trend, and the reason I'm going to call it that is whenever you're watching a stock, the trend is your friend. But the trend for Spotify for the longest time was it reaches a high, and then it gets to a low, and then it comes up, but it doesn't get fully to where it was, and then you get a lower low. And so whenever you have lower highs and lower lows, that's usually a pretty bearish indicator. But from the breakout that we've seen today, it's almost like Spotify knew I was going to be talking about it today. It went up to all-time highs of $330. It has sold off a little bit. I'll just go to the one-day chart to see how crazy of a move today was. But yeah, Spotify has definitely broken out of this bearish trend that I was watching for the longest time. And so does this make me feel bullish on the stock overall? Yeah. I think Spotify is in a great spot. The problem that I have right now is obviously I hate buying at all-time highs, especially after a 10% move. I don't like chasing these type of moves, so I would be waiting for maybe a pullback back to this upper area right here. I'll just try that out. No, I don't want the third one. And then I will set an alert for there. Because I think the long-term potential of Spotify is so good, but just right now it's a little overextended, and the fact that there's like no news popping up makes me feel kind of weird. This morning I was doing some research and it says Spotify shares are trading higher, not seeing any company-specific news to justify the price action. So whenever you see that, I am a little bit worried, but long-term I'm very bullish on the potential of Spotify, ticker symbol SPOT. Next up is going to be one of the apps that I use on a daily basis, and if you could see my screen usage, I guarantee Twitter is going to be at the top by a significant margin. Currently, Twitter is trading for $47, and it's up 47% on the year. Twitter has not been one of the best stocks for the entirety that it's been public. Pretty much for the entirety that I've invested in it, which I currently do not own any, but it seemed to have been, it does well for a little bit, and then you have a poor earnings report, and then it does a little bit better, and then it keeps falling. And one of the major stories from last year, which was from October of 2019, is they had an ad bug that resulted in a huge miss when it came to revenue, and I think the stock fell like 30% because of that. But when you look at the all-time chart, you can see that it's not super pretty. There's been a lot of gaps down because of earnings, but we started to see Twitter trend in the right direction for the past couple months. The beginning of 2020, you saw problems with the pandemic. Even with the social media stocks where usage is going way up, the advertising spending was expected to drop significantly. And so in the beginning of 2020, things were not looking too great for these companies. Then we started to see things turn around going into the summer. Recently, when you had Snap release earnings, which was the first social media stock, they reported better than expecting revenue, and they had fantastic guidance going forward. So this shot up all of the other social media stocks like Facebook, Pinterest, and even Twitter. And so that optimism pushed the stock to all-time highs, which is not something we've seen for the company in a long time. But from the last earnings report, the hot streak came to an end and it fell 11% after that news. From that earnings report, they saw a big beat on revenue with $936 million in revenue compared to the $777 million expected. But the stock fell after missing on monetizable daily active users, but that number was still a 30% increase year over year. So this is what I hate about earnings reports. When you look at the year over year growth of 29 to 30%, That's fantastic. I absolutely love that. But since it had been on a hot streak and it missed the expectations, the stock fell significantly because of that. And these are one of the examples of why I love buying after bad earnings reports, because when I look at the overall report, they had huge beats on revenue and they had a 30% increase in monetizable daily active users year over year. And I see that as fantastic growth going forward. Twitter has also been talking about implementing a subscription model, which is something that I even got an email about, trying to be an interviewee to kind of discuss how I would feel about that. So there are places where Twitter is trying to make more money in the future. There's always been the discussion that Facebook and Instagram and WhatsApp are all better places for advertisers to spend their money compared to Twitter. But Twitter has become a legitimate place for news, politics, and interacting with friends. And I think it's going to continue to increase in size in the next couple years. While Facebook is the king of social media, I think Twitter has huge potential that it has not reached at this point. I think Facebook is going to be a steady grower for the next couple years, but I think Twitter could have explosive growth, especially because it's become a legitimate place for politics, and it's bringing the older generation onto the platform. And so right now, I'm very bullish for Twitter for the long term. Short term, the way that we've seen how it reacts to earnings reports, I'm pretty neutral on it, but long term, I think Twitter is in a great spot. So let's hop on over the charts and I'll talk about what I see with Twitter stock, ticker symbol TWTR.
Okay, so here we are looking at the crazy history of Twitter. Just in the past couple years, it was down to $13, and then we've had recent highs of up in the 50s. I do want to point out something that's kind of funny, is when I was watching the stock after it had its crazy earnings report and the boost from the Snapchat earnings, I charted out this area up here, and I put an alert for 5304, because if we go all the way back, that was a level that I was watching from, gosh, when is this? This is from 420 of 2015, so that was a long time ago. And if we get really close up here, you can see that it was within like 15 cents of actually setting off that alert, but it never did. But since that time, we've had some interesting things where it pushed all the way up, it fell after the earnings report, and has been pushing up. It's been on a tear ever since. This is kind of a chart that's all over the place, just because Twitter is one of these stocks that whenever there's an earnings report, it seems like it moves a crazy amount in pretty much every direction. So after the last earnings report, it fell. I'm going to want to see a gap fill, so the next price target would be up at around $52. But the fact that it sold off and was bought back so quickly makes me feel very bullish short term and long term. It will be interesting to see if it can break this level, because as of right now, this is going to be a pretty solid resistance going into the previous earnings report, where it was unable to break through that. So I'm going to be waiting to see if it can break through that $53 mark. But right now, I am short-term bullish and long-term bullish on Twitter, ticker symbol TWTR.
Okay, when I think about entertainment, the place that I normally think of has to do with Disney. I'm a huge fan of sports, so ESPN, which is owned by Disney. Also, I've been binge watching Star Wars The Clone Wars, which is the animated show after a certain character popped up in The Mandalorian. And I'm not going to give any spoilers on that, but it was a fantastic episode. So I'm going to be talking about Disney, ticker symbol DIS, which is currently trading for $151, and it's up 4% on the year. After a tough 2020, Disney is finally in the green for the year, which is very impressive. So I've put Disney in a couple of videos in the past couple months talking about stocks that I think are at an incredible discount. This is a stock that does not fall very often. And while I wasn't able to take advantage of it when it fell like 50% at one point, I still think for a long-term potential, Disney is in a great spot. While the company has lost a lot of revenue this year from the lockdowns, they still had plenty of other revenue sources. And one of the big places that gave the stock a boost had to come from Disney Plus, which has kind of been the saving grace for them this year. Disney Plus in their last earnings report had 73 million subscribers. ESPN Plus and Hulu have also had a decent growth, but it's nowhere near what we've seen with Disney Plus. Even though Disney Plus has looked great for the stock going forward, they are operating at a loss, with a total loss for the year from the product expected at $2.8 billion. And so Disney Plus, the growth has been incredible, but I've seen a lot of stuff that most people seem to have Disney Plus just as a way to watch Mandalorian when it comes out. So it's going to be interesting to see with the lull after the season ends if the subscribers are going to stay around. With Disney Plus, it's not expected to be profitable until 2024, and the peak losses for the product are expected to be in 2022. So there's going to be a huge growth opportunity in the future, but it is operating at a loss, and it will continue to operate at a loss for a couple more years. The momentum from Disney Plus has been a huge factor for the recovery of the stock, even though their giant revenue sources have been gone so far in most of 2020. Disneyland brings in $3.8 billion annually and has been closed since March, and it does not seem like it's going to be opening anytime soon. Major movie releases, except for Mulan, have been delayed. Mulan is an interesting thing to look at because it was direct to consumer, and it seemed like it did decently well, but I don't see that as a legitimate way where it's going to be changing the industry. But I think it was a creative way to try to bring in some more revenue. It'll be interesting to see if they continue to do that, depending on how long the lockdowns go for. Looking at the last earnings report, they saw an 82% drop in operating income. They had a loss of $710 million after posting a profit of $771 million the year before. So 2020 has taken a huge hit on the company, but the stock has recovered pretty well. Disney has also announced that they're going to continue the suspension of their dividend, which was a semi-annual dividend. So the next one was supposed to come out in January after they postponed the last one. So the earliest time that we may see a dividend from Disney could be in June or July of next year. But as of right now, it is still suspended. Right now, there's definitely some short-term problems with the company, but I think whenever reopening does happen, Disney will get a huge boost from that, just based off of how important some of the places like the theme parks are to their revenue. So right now, I'm kind of short-term neutral on the stock. I think they're going to be a little choppy going forward based off of, we have a lot of optimism with the vaccine, but how long until things get back to normal and the reopening process starts? I don't really know. But long-term, I am definitely long-term bullish on Disney, ticker symbol DIS. So let's hop on over the charts and I'll talk about what I see there with Disney, ticker symbol DIS.
Okay, so here's Disney, ticker symbol DIS. Disney, not the most attractive looking chart in the world. I had some problems finding some zones that I'd be willing to trade. Tried to do my best to find stuff in here, but these levels don't really mean much to me. The thing that I do want to point out is just how steep of a cliff the company fell off of when the pandemic first started. It went from highs of $153 down to lows of $80, so almost a 50% sell-off in just a couple months. But since then, Disney has been able to recover pretty well. And so we see a couple gap ups here. These are after their earnings reports. With a company like Disney that has such a reliance on the reopening process, those earnings reports have been so critical because you can only kind of assume how the company's doing during a time like this when, they're not having the park revenue that is upwards of billions of dollars of revenue per year. And so every time the earnings reports come out, it has been shooting. And every time the earnings report has come out so far this year, they've been better than expected. We are getting to the point where we're it's positive on the year, but we want to see an all-time high, which is very close. I think with one more day like this, it would do it. But Disney is one of these stocks that I'm not going to be buying based off of price action. It is a company that I'm buying for the long-term potential of the company and just the faith that I have in this juggernaut of a company. When you go back, the stock has had such an incredible run before this. I mean, if I showed you this chart at pretty much any time, this would be a beautiful chart to look at. So it has a track record of being a fantastic investment. It's just in the past year, it's had a tough time with the pandemic. But I think when things start bouncing back, I think Disney's going to be back on track to being one of the strongest long-term investments out there. And so I have definitely been considering buying Disney multiple times in the past couple months. And maybe I'll finally do that at this point. But yeah, I'm going to be watching to see if we can hit an all-time high above the $153 mark. But we're getting pretty close considering it's 40 cents short of being at 153. So yeah, I'm long-term bullish on Disney, ticker symbol DIS.
Okay, next up is a product that I use every day and something that I'm going to have to use for the next 4 hours editing this video. It's going to be Adobe, ticker symbol ADBE. Currently, Adobe is trading for $474 and it's up 44% on the year. Adobe has a split in their business between their two major sections of their business. They have the digital media, which is stuff like Photoshop and Premiere, stuff that I use every day when I'm editing these videos. And then they have the digital experience, which is their cloud advertising, analytics, and their e-commerce tools. When you break down the revenue sources between those two, you can see that the digital media area is a significant revenue source, whereas the digital experience stuff has been pretty flat for a bit, but it does bring in a decent amount of revenue every quarter. Adobe has done a great job at switching to a subscription-based model with Creative Cloud. It used to be something where you have to buy the physical CD and it's a one-time sale, which is great for if they see explosive growth with a new product, but the recurring payments for something like Creative Cloud has been great going into 2020, and that is what I pay for right now. That Creative Cloud software business has a crazy gross margin of above 90%, and it really has no major competitors in that space. When you think of the leaders when it comes to picture editing, Photoshop has just become synonymous with it, and I don't think any major companies are going to try to take market share from them anytime soon. And so here's how that business has changed from 2018 going into 2019, and you can just see the crazy numbers coming from that part of their business. And then in addition, they've spent almost $2 billion on research and development and $3.2 billion in stock buybacks in 2019. So they're investing in themselves. They're doing an aggressive stock buyback program, which I love considering how much money they're bringing in because of their incredible gross margin. And unlike the digital media business, their digital experience, has strong competitions with companies like Salesforce, ticker symbol CRM. So they're not having as high of margins. Their profit margin is 57%, which is still fantastic. When we talked about Spotify at the beginning, they were at 25%, but it's not as good as the above 90% that we saw for their digital media business. So Adobe is king when it comes to software, and their incredibly high profit margins for their creative software makes me feel very confident in their long-term growth. They don't have a lot of competitors in the creative area, and so I think this is going to continue to be a company that grows at an incredible rate. And when we show what the charts look like when we hop on there in a second, you can see that this is a great bet for a long-term investment. So let's hop on over the charts and I'll talk about the incredible charts that we see with Adobe, ticker symbol ADBE.
Okay, so there's not a lot to say about Adobe, ticker symbol ADBE. When you see a chart like this, there's no point in really charting out zones. Obviously, it did have a little bit of a sell-off from its all-time high of $537. So that could be a decent buying opportunity. But when you see a track record like this, it's just, I really don't know what else you could say about it. It's just absolutely beautiful. This is back to 2011 when it was down, trading at $30, and now it's almost, it hit 500 this year. So the track record of this stock has just been so impressive. Their increase in revenue has been beautiful over time. They are a juggernaut when it comes to software, and I think that Adobe, ticker symbol ADBE, is always going to be a buy for me for a long-term position. I mean, I don't know how you could be bearish on a company like this. Just the track record is ridiculous. And whenever I'm looking for a long-term investment that I don't really want to worry about, I always think of something like Adobe.
And finally, we're going to wrap up this video with Yeti, ticker symbol YETI. Yeti is currently trading for $62 and it's up 77% on the year. This is a stock that I've made a lot of money on at the very beginning of my investing career. I was just a generic fraternity guy, and Yeti has been a product that I've loved ever since that point. Their quality products are so good. And one of my dream scenarios is to be fishing from a platform that is a Yeti cooler on my flats boat in the Florida Keys, and that's just my dream scenario. And their products are so high, and the cult-like following that the company has resulted in a fantastic 2020 for a retail company that was not expected to do very well, as spending was expected to kind of slow down a little bit with the pandemic. But when we talk about the last earnings report, it shot up the stock significantly. Their profit increased by 126%, the revenue increased by 29%, and the company discussed that there was still a strong demand for outdoor recreation and leisure products following 2020 with the pandemic. Their cash on hand increased from $35 million to $235 million within a year, and they also paid down $50 million in debt. They expect their sales to increase 15% in the next quarter, even with the uncertainty of the pandemic going into the holiday season. This is a stock that doesn't really get talked a lot about, and that kind of worries me for some things, but based off of their incredible track record with their earnings reports, it makes me feel very good for a long-term position. But when we hop on the charts, I'll talk about why I'm short-term neutral, but definitely long-term bullish on a company like Yeti. So let's hop on over the charts and we'll wrap up today's video.
All right, we're finishing the video off with Yeti, ticker symbol YETI. This has been a stock that I traded between the $30 mark for a long time. And this is a stock that I swing traded a lot. Since the pandemic has hit, this is 2019, and so this is the fall in March, and it's gone from $16 up to $64. So we've seen some incredible growth in the past couple months. That does worry me a little bit for a short-term play, but based off of the cult-like following that their products have, the incredible beats that they had on their earnings report, I feel very good. I also love seeing stuff like this where you have a huge beat after the earnings report, it spikes, it sells off as a lot of people are taking profits, and then it just gets bought right back up. So that tells me that it wasn't just a fluke. People are seeing this as a discount whenever a stock sells off like that, and they're buying up the stock at a discount. So that always makes me feel good for a long-term investment. It does not have the longest track record, considering it IPO'd in late 2018, and it's pretty extended right now. But if I'm thinking for a short-term play, I'm pretty neutral on it. I could see it selling back off and coming down to the 50-day moving average, which is this purple line. But for a long-term potential, I absolutely love Yeti because of its incredible products, its cult-like following, and the price action that we've seen so far in 2020, and just the numbers that we've seen from the earnings report make me feel so bullish on Yeti overall.
So thanks for watching my video on my 5 favorite stocks and talking about how I determine which stocks I want to buy for long-term investments. We talked about a variety of different products in today's video. We talked about some tech companies with Adobe and Spotify. We talked about some of the blue chip stocks that are in a lot of people's long-term portfolios with Disney. We have Yeti, which has been a cult following product that I've always loved during my college experience. And then we also talked about Twitter which is one of these social media stocks that has exploded in 2020. So let me know which of your favorite stocks you bought in 2020 and what stocks you're looking to buy going into 2021. Thanks for watching. I appreciate all the support, and I will see you tomorrow.